for tuning into Talking Point. I'm your host, Niraj Shah, and our guest today is Sushant Bhansali of Ambit Asset Management. Sushant, great having you. Thanks for joining in.
Thanks, Ines. Thanks for having me here.
So, Sushant, you would argue that while Indian markets are in new highs, point to point, from about October 2019, we are up maybe 2-3 percentage points, not even 3 percentage points. So, what's the sense about how have the internals done within this consolidation phase, and does this therefore lead to an up move, or is it because Indian markets have done better than the others that India might still underperform compared to the other markets?
Yeah. So while I think comparing to global markets and other markets is only, I would say, visible to us in hindsight, right? Sitting here in India, I think better to just focus on Indian markets and how Indian markets can go, right? Globally, the only key points from an equity perspective, I would say that given that interest rates looks like now nearing the settling period, right? And probably some few small increases, and not beyond that. The liquidity in global markets should be there and should drive the markets back. But how much we don't know. It will all depends on how the earnings play out there, right? From an Indian perspective, I think last 1 year was sort of a consolidation phase. I think we were lucky to not give up too much during the last 1 year. There were at times moments of 10-15% corrections from the highs, but still it was not that bad. Typically, towards the end of a cycle, you will see large drawdowns, especially in mid and small caps, right? But we didn't see that yet, and hopefully the consolidation phase is over, and we, as market is seeing new highs. As the year progresses next year, probably with the global liquidity coming back to Indian markets, we are quite bullish on the Indian markets for next 2 years.
Hmm. Interesting. Sushant, the character has been very different for 2022 in that value, by and large, has outperformed growth. Growth, if anything, has corrected quite viciously as well across markets and India. Uh, in your constructive argument for the next couple of years, do you get back to growth at slightly above reasonable price, kind of a fun, kind of a theory, or is it that growth in value will continue to outperform?
Yeah, so growth and value both are just a function of how market is valuing them at any particular time versus the earnings growth visible on the stocks or companies, right? Now, if you look at the growth stocks did quite well between 2015 and now, because these were the sort of stocks which were still delivering earnings, while a bulk of the companies were not delivering, and many of them became value stocks over a period of time, right? And what we are seeing is that earnings on those value stocks, the supposedly value stocks, have been decent in the last 1.5, 2 years as the country opened up from lockdowns and as we move from unorganized to organized to a large way. And sort of some capex has started happening, especially government capex, right? So the earnings on those companies have done quite well. Whether you look at PSU banks, whether you look at utility companies, whether you look at metal companies, for that matter. So market is just rewarding the earnings, right? When growth stocks, the supposedly growth stocks were only delivering earnings, everybody was behind them and which was driving their share prices. Now, when there are other alternatives available on earnings, market is rewarding and there is sort of a mean reversal in those stocks. This is how I would say to sum it up in terms that market is just following earnings and nothing else.
Okay. Where is it based on the first couple of quarters' performance as well as the con call commentary and your analysis? Do you believe the earnings growth have the best chance of showing an uptick over the course of the next 24 months?
Yes. So typically last 10 years, if you look at it from 2011 to 2021, right, most of the times the economy overall faltered on the earning growth estimates, which all sell side or even probably buy side people had, right? We always thought that whether the benchmark index, whether Nifty or Sensex, they'll deliver 15-20% earning growth, and they faltered. Now that faltering was, if you look at analyze them, that every year there was one or two sectors or one or two large companies which were not able to deliver and were probably in losses, right? Give you an example like AQR, which disturbed the banking balance sheets and PNL, or at times metals which didn't perform, or at times auto stocks which didn't perform, and they were taking it behind the Nifty earnings growth. right? If you look at again last 1 year, or probably just look at the Q2, which just finished, right? If you see the year-on growth is now low single digit on an adjusted basis. On a complete basis, it's actually flat. If you take out banks from this pack, then we are a big negative 15% sort of growth, right? But if you take out materials companies, oil and gas, metals, etc., then again it comes back to positive, right? So all these growth rates are an average of many sectors and companies, right? And if the economy is sustainably not growing, then there will be always one or two such sectors which will drag the earnings down, right? As we move forward, I think we have come a long way, and demand is in good shape. And capex probably will happen. Government is spending a lot, and private capex is gradually starting. There are large corporates who have not done capex in last 10-15 years. They have now come out and started doing capex, especially in the FMCG arena as well, right? Now that I would say that should drive the overall economy, and that would also mean that most of the sectors will continue to perform. The growth rates might differ between them, but there will be not no large drags in the system which will take the earnings down. And therefore, we believe that there is a good chance to deliver double-digit earning growth for the next 2-3 years overall. Neeraj, you are on mute probably.
Yeah, I mean, within that construct, Sushant, where is it that you believe will be the best delivery of earnings from within all the pockets which will do better or do good, which will be the ones which will do better?
Yeah, so I think most of the mean reversal has happened, right, in terms of the earnings getting back to normalized levels for most of the sectors. Now, if you look at IT sector, it delivered really well last year in terms of stock market performance, right? This year they didn't, it just got mean reversed, right? But at the same time, the growth rates in that sector seems to be quite nice as and better much compared to the last 5-7 years of growth which we saw, because the world is into the digitization sort of mode, and it shall continue. So we are quite bullish that IT sector will do well, right? The consumer
on earnings front, you mean?
On earnings front,
Okay.
yes, right. They will continue. They had been this year also. They delivered well. I think expectations were going berserk towards the end of last year, which has sort of now become reasonable, right? And they shall continue to deliver those earning growth. And probably consumer discretionary should again come back in flavor and deliver good earning growth. These will be the leaders of the pack. Banking sector has to deliver if the economy has to do well. So that's another sector where we believe that there will be good earning growth. Then all the material companies will all depend on global factors. So one cannot take a stance sitting today whether they will deliver reasonable earning growth or not.
Okay. There is a lot of chatter around themes which have not done well for years, finally coming to the fore and delivering earnings. So if defense is a case in point, suddenly railways have come into the picture. And while textiles have had an iffy last 6 months because of the Western issues, the belief is that the earnings growth because of deleveraged balance sheet over the course of the next 3-4 years will be very, very strong for that pocket as well. What amongst the, how do I say, the sub BSE 250 mark as a theme, do you believe has chances of very strong earnings growth?
Yeah. So as I said, Neeraj, earlier, that during tough times, there are select group of companies which are able to deliver earnings, right? It can be true for sectors also. It can be true for strong versus weak players also. When the overall economy does well, and you refer to the period between, say, 2001 to 2002 to about 2007, those 5-6 years, there was good growth across sectors, right? Where each and every sector participated. And there, if you see the small and mid-cap companies, they delivered much more in terms of earning growth, and they were equally rewarded by the stock markets as well. And if our belief is that now the issues of the economy are behind us, all the structural reforms have been taken care of, we have good political stability, which probably will continue from in next 2 years as well, then probably economy should overall do well, and the mid and small cap companies especially should deliver much more than large caps. If you look at it, last 5 years, large caps have delivered more returns. Right, if you look at December 2017 versus now, large caps Nifty itself is up about 80 odd percent, right? But the mid and small cap index are up only 50 odd percent. Right. So it's not about just probably valuations where they are, but about earnings growth. So since demonetization, I think there have been one or other event every year which has dragged the overall economy progress down. Right, the GDP growth has been sort of benign. Right, we are doing better than everybody else as of now. Right, but overall GDP, if you look at last 5 years, we have not done too great as we did between 2000 and 2010. Right, so now from here on, if we are able to deliver between 6 to 8% GDP growth every year, then there's a lot of smaller companies and mid-sized companies which will prosper and deliver much more earning growth as compared to the established players from the large cap side.
Very interesting. Are these bottom-up ideas or are these thematic in nature as well, Sushant? Maybe a sector itself could do very well, and within that, some of the leaders could do well. So, are these outperformers going to be very bottom-up and sector agnostic, or are there some themes as well?
So see, there will be always be pockets. So what I would say is that if the normal range of earning growth was high single digit probably in the last 10 years, then we are more looking at low double digit as the normal base.
Okay, fine.
Right. In that context, there will be, of course, sectors who will deliver 20% earning growth plus in the next 5 years. Right now, these can be, if you, as you rightly said, if the demand picks up, then textile sector can be one. Right, light engineering goods can be one, manufacturing sector can be another one, consumer discretionary, right, and more importantly, next 3 to 5 years, there will be more companies which will be added to the listed markets. If you see all these unicorns in last 5 years, many of them will get listed. All of them are coming with very really high earning growth. Right, in terms of revenue growth, I would say earnings will still yet to come in most of them. But our belief is that if the economy does well in the next 2-3 years, many of them will turn profitable, will come to the markets, and they probably will also drive the earning growth for the overall.
Sure. Sushant, I'm using this as an illustrative purpose, of course, but Paytm in its meeting yesterday spoke of cash flows, positive free cash flows. There is momentum. And I was looking at all of these platform companies, despite all the supply pressures that is there in the month of November, right? From 1st November, the maximum loss has been about 20%. In some cases, the stocks have actually gained. From a market viewing perspective, have these stocks kind of hit a plateau from where they might consolidate, if not go up, but downsides may be limited? And are you guys tempted to look at them? Do you have them in your portfolios now at these discounted valuations, so to say?
Yeah, so valuations are only discounting the earnings, right? The earnings are just not there, is how I would summarize it, right? And that's why we are still staying away. We like a few of these platforms, right? I think they have built really good businesses which are very scalable and will deliver lots of earnings. But in our belief, they are still in the dream zone, where you have to dream out as to how see, not all of them will be winners. There will be few winners, and when they come back with earnings, I'm telling you, a few of them will create really big businesses. Right, they will be amongst the top 5 to 10 profitable companies in this country in the next 10 years. But which one of them will be, you never know. Right, so from our perspective, our philosophy is that you look at the track record of the past of portfolio companies, take adjusted risk, and don't take too much risk. I would say that these companies, from our perspective, are still on the higher side of the risk, and we are staying away from them. But whenever companies start showing it starts with free cash flows, then it will move towards profits. Once we see the trajectory, probably someday we'll push the button as well.
Got it. Okay, so wait for the free cash flows to come out before you try and think about doing these things. Okay, Sushant, thanks for that. One more question, actually last couple of questions. One is on, again, I'm using this as an illustration, but Westlife, the McDonald's operator, yesterday in the analyst meet, spoke about a vision 2027. So 5-year CAGR of about 16 to 18%.
Yeah.
Urban consumption, right out there, 16 to 18% CAGR growth on revenues with better margins, better return ratios is great. Do you believe it could be almost unanimous across this whole urban consumption theme? For 2 years, they've lagged. Now, maybe because of revenge consumption, there's an unnaturally high growth rate. But over a period of 5 years, do you think these stocks have the potential to make money for shareholders?
So I would say that the habit of eating out has been changing. It started from metros, I would say, a few years back. It has now reached out to tier 2, tier 3 cities. And gradually, as more and more options start getting available, it will go to tier 4, tier 5 cities also. Right. If you just use the same analogy of how I would say mutual funds have reached. Right now, if you look at, if you ask the digital players, right, there's some interesting stats which they share where they say that beyond 100 cities, they are getting maximum growth. Right. And all these are digital players. So it's not that the mutual fund distributors are taking them. They themselves are coming to it. Right. So people are getting matured and moving from probably hard assets to financial assets in those markets. Right. So when you see that trend, you can, I would say, easily assume that they will their preferences on consumption side, especially on the food side, will also change over a period of time. We are a very large country. There's probably a lot to do on urbanization side. Right now, probably we have 50 large cities in the country. In next 5 years, there will be probably 150 large cities, right, with a population of 2 million plus. And when you are becoming part of a urbanization center, right, the food habits, eating out habits do change, right, because of paucity of time, because of social reasons. You tend to go out, right, spend more time outside the work to eat out. Or probably if you are busy, or probably you are both husband and wives are working, then you start ordering food as well. Right. And these eating habits have changed. Like you see our lives in metros, right? We hardly used to eat out till about 10 years back.
Sure,
Right?
sure.
Probably once a month. Right now, probably it's gone to more than once a week. Right. Similar things will happen into these places where probably people are still eating once every 3 or 6 months. Right. It will come down to once a quarter, and then once a month, and then once a week as well over the years. So the opportunity is right there. Now, which of these players will be able to use that opportunity and create a great sustainable business model? Only time will tell. Right. The opportunity is right there for the consumption story to play out. But then it will be left to people who gradually build their businesses, don't go overboard and spend large cash flows and not get to search the growth. So one has to build a sustainable business model, and there are few good companies who have done it quite nicely in the last 3-5 years. So we are pretty sure that such themes will emerge, and one needs
Got
to
it.
take a calculated calls on which are the winners from that side.
Got it. Sushant, my final question. What is the dark horse then? You've spoken about positivity across spectrum, across sectors. Most things could do well. I would love to understand which is Sushant Bhansali's favorite.
So our
5-year view.
5 year, I'll give you 10-year view probably.
Brilliant.
Right. So affordable housing is something which we are really bullish on. I think affordable housing has been happening. So ultimately, if you look at the premiumization story will play out when it will, right, in next 10, 15, 20 years. The real story which has played out in India in last 20 years is about unorganized becoming organized. Right, across any category you take, whether on food, cloth, BFSI, everything you take, I think there's a lot to do in many of these categories from unorganized to organized. We saw a lot happening in the last 2 years once the lockdown started and the unorganized sector just went out of business. But BFSI as a sector, I would say, is still there is a large unorganized play yet. Right, people are paying 2%, 3% per month as interest still in macro markets, right, beyond the top 100 cities. Right, so there is this large opportunity, whether it's affordable housing, we may say, right, because of regulatory pressures, you are not able to charge that 2-3%. Right, so we see great scope, and there are not too many people who are doing that in the country.
So you mean the realty players, not the ancillaries, the realty players themselves?
No, I'm saying the realty is very difficult to play from a listed market perspective.
Okay.
Right, because real estate player will always be in some micro markets. We are yet to see a large Indian player across all the micro markets in this country on the real estate side.
So then how do you play this affordable housing team?
Play through BFSI.
Okay.
The lenders on the affordable housing side.
Interesting. Okay. 10-year view,
Yeah.
affordable
So
housing.
there are few players who have built balance sheets of between 1,000 to 10-15,000 crores. Right, there is a big opportunity where these opportunities can be if somebody is able to become a pan India player. right? And then probably expand to nearby markets like either Bangladesh or Sri Lanka and things like that. Right? That also is an opposite, similar sort of landscape, right? A similar sort of credit behavior probably. So the opportunity is there. So I will be not, I would say, surprised if somebody is able to build the next HDFC out of the affordable housing place.
Okay, we will watch out for that. That's our headline for the day. Thanks, Sushant, for joining in today and giving us your thoughts. Really appreciate your time.
Thank you.
And viewers, thanks for tuning into this edition of The Talking Point.
Thanks, Niraj.